You check your bank account. The number hasn't changed. You check the news. Inflation is down. The headline says prices are stabilizing. You should feel relief. But something's wrong. You're earning the same salary you earned 2 years ago. Your savings account has the same balance, and yet somehow you can afford less than you could before. Not dramatically less, just less. Welcome to the quietest way you get poorer. There's a word economists use when they want to calm you down: stabilization. Prices are stabilizing, inflation is moderating, the economy is cooling. It all sounds like good news, like the problem is behind us. But here's what they don't say out loud. Stable prices don't mean low prices. They mean prices have stopped rising as fast as they were. The damage? Already done. And it's permanent. Let's rewind to 2020. A gallon of milk cost around $3. By 2023, that same gallon cost $4.50, maybe $5 depending on where you live. Now, in early 2025, it still costs about $5. The price stabilized, but it stabilized at $5, not $3. Your salary didn't jump 50% to match. Your savings didn't magically grow. The milk just costs more now, forever. This is the part they leave out of the headlines. Inflation is measured year over year. If inflation rose 8% last year and 3% this year, the headlines celebrate. Inflation is cooling. But your cost of living didn't cool, it compounded. Let's say you had $10,000 in 2020. With 8% inflation in year one, that money now buys what $9,200 used to buy. Then another 5% the next year. Now it buys what roughly $8,700 used to buy. Then 3%, now $8,400. Even when inflation stabilizes at 2%, that $10,000 is still losing value, slowly, quietly, every single year. The number in your account stays the same. The power of that number keeps shrinking. And this is considered normal. Here's where it gets strange. Central banks around the world don't target zero inflation. They target 2%. The Federal Reserve, the European Central Bank, the Bank of England, they all aim for 2% annual inflation as if it's some kind of natural equilibrium. Why 2%? The official answer is that it gives them room to maneuver during recessions. If inflation is at 2%, they can cut interest rates without triggering deflation. It keeps the economy flexible. The unofficial answer is that 2% is slow enough that most people won't notice. You won't riot over a 2% loss in purchasing power. You won't storm Congress. You'll just quietly adjust. You'll buy the smaller package, skip the vacation, delay the car purchase, and the system keeps running. 2% sounds small, but over a decade, that's a 20% loss in what your money can actually do. Over 30 years, it's nearly half. Half your purchasing power gone. Not because of a crash, not because of a crisis, because of policy. Now let's add the other half of this trap. You've been told to save money. Put it in a savings account, build an emergency fund, be responsible. So you do. The average savings account in the United States pays about 0.4% interest right now. Some high-yield accounts offer 4 or even 5%. Sounds good, except inflation is still running at around 3% depending on how you measure it, which means even with a high-yield account, you're barely keeping pace. And if you're in a standard savings account, you're actively losing money every year. Your bank thanks you for the deposit. They loan it out at 7%, they pay you 0.4%, they pocket the difference, and your balance slowly rots. This is what financial advisors mean when they say cash is trash. Not because it's worthless, but because holding it guarantees you get poorer. So what are you supposed to do? The system pushes you toward risk. Stocks, real estate, crypto, anything but cash. You're told that if you're not invested, you're being irresponsible. And maybe that's true. But let's be clear about what's happening. You're being punished for holding money. You're being forced to gamble with your savings just to stay even, not to get ahead, just to not fall behind. And when the market crashes, as it does every decade or so, you lose anyway. But when you were holding cash and inflation ate it, nobody called that a crash. They called it stability. There's a darker layer here. Who benefits from inflation? Even the slow kind. Debtors. specifically the largest debtor in the history of the world, the United States government. The national debt is over $34 trillion right now. That number is so large it stops meaning anything. But here's what does mean something. That debt is denominated in dollars, and every year inflation makes those dollars worth a little bit less, which means the debt, in real terms, shrinks. If the government owes you $1 trillion today, and inflation runs at 3% for 10 years, they effectively owe you about 30% less in actual value. They didn't pay it down, the money just got cheaper. You, on the other hand, don't get to print money. You just watch yours lose value. It's a transfer, slow, legal, invisible. Here's the irony. The people who get hurt most by inflation are the ones who are told to celebrate when it stabilizes. The people who don't own assets, who keep their money in checking accounts, who live paycheck to paycheck. The people who own property, stocks, businesses, they're fine. Their assets inflate with everything else. A house that cost $300,000 in 2020 might be worth $450 now. The price stabilized, but it stabilized higher. If you owned the house, you won. If you were saving to buy one, you lost. Stabilization doesn't undo the damage. It freezes it in place. And now we're being told this is the new normal. Prices won't go back to 2019 levels. Wages might catch up in 5 years, maybe 10. Until then, you adjust. You budget better. You side hustle. You optimize. The phrase you'll hear is sticky inflation. Prices are sticky on the way up, they don't unstick on the way down, which raises a question nobody wants to answer. If inflation can spike to 8% in a year, but takes a decade to fall back to 2%, and prices never actually retreat, who designed this system, and for whom? You're not imagining it. Your money does buy less, even when prices stabilize, even when the news says things are getting better. Because better doesn't mean what it used to mean. It just means the bleeding slowed.